Thank you all for spending some time with us today. Larry suggested we sort of change the format of this luncheon a bit. I'd previously spoken in the past about how to select the right commercial bank, the right banking relationship for your business. And today I think we'll focus a little bit more on getting a commercial loan. There seems to be a lot of hue and cry in the mainstream press about how difficult it is to get a loan these days. Certainly a lot of the headlines seem to suggest it's impossible to get a business loan. So fairly suggested I talk about how, in fact, a small growing business can get a commercial bank loan these days. We'll have the same time format, though, as the prior, okay? And I'll be very respectful of all of your times as well. The simplest and the easiest thing to try to do to get a commercial loan is make sure you're at the right bank. It seems obvious, right? But the reality is that not only are not all lenders alike, and there are different sources of financing, but all banks are not alike.
Excuse me, your hand's in the shot.
And in fact, even before you decide that you're seeking bank financing, I think it's important to understand that banks look at credit a particular way, and that the way that a bank will process or underwrite a credit request may not be the same way as other lenders, other sources of capital. Everybody's talked about it or spoken of hard money lenders, factors, asset-based lending, VCs, merchant banks, investment banks, friends and family. There are literally a dozen sources of capital for a new and growing business, and a commercial bank is only one of them. So without going into the advantages, disadvantages, or the relative characteristics of these various types of lenders, I assume that the business that you have is bankable and that talking to a commercial bank makes sense. Having said that, it is critically important to know who your bank is and make sure you have excuse me, the right bank. What do I mean? Well, a couple examples. Banks look at credit differently depending upon their size, their expertise, their capital ratios, their location. So one of the first questions I would suggest a small business person ask of their banker is, do you guys make loans in this area? If you're a restaurant, you make restaurant loans. If you're a startup, you guys even consider making loans to startups. I'm a government contractor. I'm starting up, but I've got a 3-year history, and I've got this type of government contracts. Do you have an expertise in this type of lending? Make sure there's a match between the type of business you have and are growing and the experience and expertise of the bank you're talking to. Make sure you're talking to the right person. People speak of banks as if they're monolith. Actually, banks, like most of the companies that you all represent, are composed of talented individuals. And it's the relationship that counts as much as the organization. And what that points to me is that you need to be having a conversation, not with the assistant branch manager. I'll pick on Bank of America for a minute. Not having this conversation with the assistant branch manager of your local Bank of America branch where you have your personal account, and oh, by the way, you guys make loans to small business. The answer will be, sure, absolutely, come on in, Mr. Smith. That's probably not the right person for you to have that conversation with. I suspect as a small business borrower, you need to be able to have a dialogue with the lender at that organization, and probably a dedicated small business lender. Somebody whose job it is to make loans, somebody whose job it is to understand the credit requirements of your business and be able to speak knowledgeably about that bank's product offerings and whether or not there's a match between what you may think you need and what they can offer. And I say what you think you may need because one of the points that is interesting to me in talking to a new borrower, even an established company that has grown but perhaps is in need of capital to facilitate their further growth, is they may not have a clear understanding of the type of credit facilities that may be available from the bank. They may not have a clear understanding of what they should even be asking for. I need money to grow my business, right? Well, is it a line of credit to grow your accounts receivable? Is it to fund the soft costs for some tenant fit out when you're moving into a new lease space? Is it a new telephone system? Is it 2 new trucks? Is it to refinance your warehouse? All those transactions involve the advancement of credit, but how they're structured may be totally different. That's why having a banker that you know and have a relationship with is helpful. Very often, maybe the first conversation is, Tom, I think I may need some more capital. Let me tell you about where my business is going, where we think we want to go, the kind of credit I think I might need to help get where I want to go. That first conversation can be very educational if you're speaking to a banker who in fact is knowledgeable about credit themselves and can understand not only the bank products, but the needs of a potential growing borrower. When you dig a little bit deeper, I think at some point it's also very important, in order to know the right fit between you and a potential bank, understand the general way that this bank will look at this particular credit. I assume now you've had a conversation and that bank will or will not make a loan to a startup restaurant, or wouldn't have the further conversation. But assuming they do, make sure you have a conversation about what is the process and the procedure like. What does that mean? Well, banks have authority levels. Almost no lender can just say, here's your loan. Brooke and Herbert used to do that, but even they don't do that anymore. Often a bank will have a fairly precise process, procedure by which loans are underwritten and credit decisions are made. It can be very helpful to find out, if you're the borrower, what is that process? I want to borrow $600,000, David. I want to borrow $400,000 to refinance my warehouse mortgage with BB&T. I want to, or PNC. I want to look at a line of credit because I'm growing, and I want to buy 2 more trucks. So, I don't know, it's $700,000, $800,000. What does that look like? It can be very helpful to understand very early on that the bank will only lend on commercial real estate at 85% loan to value. And if you're looking at a 90% loan, well, that may be tough, absent some SBA or other guarantees. But an early, fairly preliminary conversation can give you a lot of information on what the structure of the bank is for a particular credit type or industry. What kind of terms and conditions, covenants, are frequently employed in a particular type of credit, a credit facility. Is the bank really stickler? Do they have liquidity covenants, net worth covenants, debt service covenants? What are the common types of things the bank will use to protect it? And make sure you understand that that's generally what the bank will look at. In terms of the process and the procedure of going forward, it's often helpful to know the authority levels. If you're dealing with a low-level lender, he may have no authority, in which case, as is in the case of most banks, he'll have to seek approval for that credit facility by going up the line. Usually there's a series of committees. There may be an executive committee, a loan committee, an officer loan committee, director loan committee. And usually the level of authorities and the number of eyes that scrutinize the credit transaction depends upon the size and nature, primarily the size of the transaction. For a small loan, it's this $700,000 hypothetical loan. Who has to prove this, John? Can you do this? Does your boss and you approve it? Do you need 12 guys or 27 guys? And how long will it take 27 groups to? I use the number 27, I'm not sure why, but it seems as though some of the lenders we've talked about, some of the larger banks, complain about the, quote, 27 levels of authority they have to go through to get their loans approved. But having a conversation with your banker about the internal processes of your bank in approving a credit that you may request can be very, very helpful. All this just should tell you if you're at the right place. At the outset, I'm obviously a fan of community bank. This is the second community bank I've started. We're a 5-year-old, about a $500 million community bank, First Virginia Community Bank. And if you're a small but growing business, you should probably be talking to one of us. There are 15 banks like us in the area. Faraday will say, don't say the name of anybody else. Faraday's my #1 business development officer. But truly, I think you should be talking to a community banker, a commercially focused business bank, not necessarily a consumer retail expert, but somebody who understands small business and whose bank is set up to provide the products and services that small business need. With the recent financial services meltdown, or as some of the investment banks are calling it, the recent unpleasantness, whatever, people have read more about banks. And I think there's a better understanding today that the banking industry is very segmented. The money center, $50 billion and other national consumer retail banks have a set of business, a model, a financial model that works for them. The $50 to $10 billion commercial quasi-consumer banks can be very responsive. And then there's a whole slate of $10 billion and other commercial banks that have really stepped up into the void and whose business model involves lending money. Many of our bank and many of my peers survive and grow, and in fact are designed to serve the needs of small, growing businesses in our footprint, in our marketplace. Those are the type of bankers and the types of banks you should be talking to. Banks look at credit, and I'll finish up very quickly. Banks look at credit perhaps differently than any of the other 11 types of lenders that I mentioned at the outset. Generally, a small business bank is not a collateral lender. Hard money lender may say, what's the value of your collateral? We also like to know that, but we lend basically on debt service coverage. We want to know that the project or the reason we lend the money will generate sufficient cash flow to pay us back, pay our interest and principal, and pay the whole principal back if there's a balloon payment after the end of a term of 5 or 10 years. And so what that means is for our bank, as well as most of the banks that I know pretty well, we participate credits with almost every bank in town, so we know not only how we underwrite credit, but how our participants underwrite credit. And the first and foremost thing is cash flow. Where's the cash flow? What's the cash flow? One of the benefits of working with a smaller bank is we can sometimes employ what we call global cash flow, even if the specific $2 million loan for this project doesn't cash flow. If the affiliated group of borrowers or businesses have other cash flow that do cover the requirements of the loan globally, smaller, more focused commercial lenders, I think, have the ability to look at global cash flow. But at the end of the day, if there's not cash flow to cover the debt service and the repayment of the principal, it's a tough road for a bank. You know, I've had situations where a borrower will say, well, I don't have any income, but I did in the past, I'm sure in the future I will have, and I've got this great property that's worth $15 million. I just want you to lend me $5 million. You have a 30% debt to net worth. There's no risk of loss to the bank, but I can't show how I will ever pay this loan back. But don't worry, bank, you can foreclose on the property, take it, and you'll get covered. There are lenders, and a lot, would love that transaction. It's probably not a commercial bank transaction unless we know the borrower real well and know that they were the CFO of XYZ company and made $2 million a year before, and likely will make $2 million in the future. But a guy off the street, even though that seems a perfect transaction, is tough for a commercial bank to do. Part of the reason we look at credit differently, and this is something that in fact the Main Street Press does have right, the enhanced regulatory and legal burden scrutiny that commercial banks are under since Dodd-Frank and other legislative and regulatory projects have been out, do require us to answer to a higher authority, i.e. the Fed, on how and why we make loans. But I think it is true that cash flow will trump anything else. Banks are often accused of, you only lend money if the borrower really doesn't need it. And there's really some truth to that. We lend money to people who we know will get it paid back. Let me distinguish the risk-reward profile from a bank where I make a 5% yield. I run a bank on the 5%. I pay my depositors, I pay my rent, I pay my salaries. The net interest margin of 5%, and plus I put a 1.15% reserve against allowance for loan losses going forward. That 5% margin yield that I get on the loan, actually the margin with all the deposit costs probably shrinks to less than 4%. But the yield that a bank, a commercial bank, gets on making the 5% loan is not enough to cover a repayment loss. We're not a VC. We don't lend money to 10 people thinking, wow, if I get one real big hit and I get, with my warrants and options, I'll be made whole. That's not our business model. So to the extent that people say banks lend money to borrowers who really only don't need it, the truth in that is that we lend money to people we know will get paid back. And so if there is a high degree of risk, and there always is, but a higher degree of risk in the repayment, it may not, the risk reward, the margins that banks, commercial banks operate on, may not justify us making that credit decision. If there's a risk of loss, we probably will walk. In our loan authorities and in our loan committees, officer loan committee, director loan committee, frequently the authorities will ask, what's the primary source of payment? It better be cash flow. What's the secondary source of repayment? Well, better be collateralized. But then we don't stop there. What's the tertiary source of repayment? If the first two fail, how will the bank get out of this? So we underwrite credit carefully. We want to make loans, but we can't make loans and won't make loans to every even viable business operation, just because the risk profile that we operate under is different from many of the other lenders who are out there. Hard money lenders, often I'll have a transaction, the guy who I didn't know, or I would have probably lent him the money, who had the $15 million property, wanted $5 million. I can't make that loan, but there are a lot of property, hard money lenders would love to lend on the collateral. Guess what? If the guy loses his property, they're fine with that. And that's not the commercial bank model. I never want to own any of your properties. But why take it as collateral, you'll say? Well, because it makes sure that you guys are really committed to make sure the bank is paid back. Same reason guarantees are sometimes important. Bankers will tell you, lifelong bankers, I'm not a lifelong banker, I'm a merger and acquisition lawyer who's become a banker later in life. Bankers will frequently tell you that no one gets paid on a guarantee. No one gets paid on a guarantee. Earl Gunn, the 42-year banker, has told me, well, you don't get paid on guarantees. True. However, what guarantees do provide the bank is a significantly motivated borrower. They'll work really hard to make sure the loan is paid back. So, as I said, because we don't want to own your collateral, collateral is important as a secondary or tertiary source of repayment, but it's not the way we make a loan. In fact, if that's the only thing I have to get repayment, I won't make that loan because I do not want to own your property. On a bank's balance sheet, OREO, other real estate owned, is not a good thing. We have none. I would like never to have any. I don't want ever to take back collateral because that's the only way to get paid. I do it if I have to, and I have the legal rights and remedies to avail myself of the full range of options that banks have. But at the end of the day, that's not how we want to get paid, and that's not how we structure our loans. The most important thing to get a good loan is know that the bank you're talking to likes the space you're in or has experience in the space you're in. Make sure you're talking with a banker who has some experience, or even if he or she doesn't have experience in in the moving business, that the bank and another officer does. How many moving companies do you represent? How many loans have you made to freight forwarders or related businesses? Understand the credit culture and the process and the procedures that a bank will use to underwrite your particular credit. Everything from legal lending limit. There's a lot of different specific questions that you'll get answered when you have this conversation or dialogue with your banker. Finally, understand that because banks never want to own your property, they don't want to own the collateral, banks make loans based on financials. We lend on paper. It seems silly to say, but at the end of the day, we lend on paper. If your bank has a requirement for 3 years tax returns, audited financial statements, personal guarantees, if you don't have those, if you don't have a review statement, let alone audited, well, right off the bat, maybe either you're not bankable or maybe this is not the right bank for you. Before you waste your time or the bank's time, understand the kind of level and extent of financial data that your bank will require, and is it doable? If you're a QuickBooks operation, you have good books and records, they're QuickBooks that you prepare yourself, you've never had a CPA look at your books, that's fine. But when your banker tells you, well, I'll need 3 years of CPA prepared compiled statements, well, you know, right off the bat, they may be a little bit difficult. When you do find you have the right or related financials that could satisfy the bank, and you're at the right bank and the right banker, present your financials in person. I'm often amazed that people don't realize that banks lend to individuals. We are a relationship business just like you are. If I like you, I still may not lend you the money, but there's a good chance I'll figure out a way to try to do it than if I don't know you. And the way you get to know a banker is by meeting them. Bring in your financials in person. John, let me explain. We had a great 2010, 2011. 2012, we lost his contract. Our revenue slipped. You know, we had a loss for 2 quarters. This is how we fixed it. I didn't want you to look at those numbers and see the wrong trends. Explain the positive trends. Explain your business. Be passionate. That's the time to be passionate about the strength. Your passion won't carry the day if you don't have the financials, but passion can go a long way to overcoming an anomaly, an oops. We all have oops. When I practice law, and Tom can, I'm sure he has the same story. I have to tell my business clients, if you don't have the name and telephone number of a banker to call on a Sunday night when an emergency erupts or you're blowing a covenant, you don't have the right banking relationship. You need to have the telephone number of that banker. You need to be able to explain your business in a fashion that makes sense. And then bug them. Don't just give them the financials, deliver it, and wait for the bank to call you. Oh, John, how you doing? I have my financials. Anything else you need? Anything else I can provide you? You know, you said 2 weeks. It's been a week and a half. You got everything you need?
Yeah, Dave, have you ever found somebody like Larry's business plan writing helpful in that process?
Absolutely. Yes. It does a couple of things from our perspective. It shows that it's not just passion driving, but clear, articulated vision as to what the market is, the manner in which you'll attack that or deliver your product or service to that market. Very, very helpful. The other thing that Larry or somebody like Larry brings to the table for a commercial banker, even in a startup, is he understands how banks think. Banks use words that sometimes normal people don't, as every profession, lawyers, doctors, Indian chiefs, I suppose we all have our own unique vocabulary. But Larry speaks bank, and so he knows how to properly present in the business model or in the other present material to a bank. It actually makes it a lot easier to understand and to answer the question that we need answered. I think that's, you know, those seem all very, very basic, but if you do those 4 things, your chances of getting a business loan will be significantly enhanced, as simple as they may be. Yes?
So I have a question, Dave. In the event that there's a parting of ways between my banker and the community bank that I love, who do I follow? Do I follow the banker to their new bank?
Do you love the banker? Or do you love the bank?
Love the community bank, but for reasons
I'd follow
that I
the
wasn't
banker.
told, follow the banker.
That's a person, you know, we try to, you know, we say, you know, we're loyal to our customers and what our customers, that's true. But we do that through the offerings, through the loyalty, through the personal emotional contact of a banker. Your banker is the most important resource. If you love your banker and they leave to go to another bank that fits the kind of lending profile that you want, go with the banker. Absolutely.
And then one last question. So in a world of community banking relationships where my credibility and character is key,
yes,
how are you guys leveraging technology, specifically social media, to get a glimpse into my character as a person as part of the
We don't. In terms of the character issue, I mean, the character is one of the 4 main C's of credit, and character is becoming much more important in terms of how a bank evaluates a credit opportunity. But we have no formal mechanism in place in our underwriting standards where we'll search the, you know, social media to find out if anything nasty has been. We'll do a Google search. We'll look at articles written. We'll certainly do things that maybe border on that. Obviously, as part of UCC, Dun & Bradstreet, credit check, other things come up, certainly lawsuits, liens, those kind of larger issues. Google, those broad-based internet searches have sometimes been helpful to reveal things that may be not in the financial press, but in the, you know, in social media. But we don't have a formal discipline requirement. It's not one of the things that's on our checklist. Did you check the, you know, did you check this guy's status on Facebook? And maybe we should. We haven't done that yet. We don't currently.